Hi, my name is Stephen from Navigator, and today I'm going to show you how to complete a profit and loss table for the long put strategy using the spreadsheet that we've created. So if you don't have this spreadsheet, you can download it from our website, sharenavigator.com. And if you go to the members area where we have our long put strategy course, you'll be able to download this spreadsheet from there. So if we look at the very first section here, you can see there's data inputs, and any box that's highlighted in yellow, that's a data point that you have to put in some type of data. So let's go through it now. First piece of data you need to input is the stock name. So if you were trading Apple here, for example, you would change the ticker symbol to Apple. But we're going to leave it as Microsoft because that's what we're doing. The current share price of Microsoft is 61.26. So all we're doing is putting in the share price. And the trade date, it's just the day you intend placing the trade. So that's today's date, which is November the 28th. You can see here that the option type, it's grayed out here. That means it's automatically populated. You don't have to put anything in there. And the quantity, let's say we're going to change that. We're going to do 2 contracts. And our expiry date here at the moment is December the 9th. We may want to do December the 16th. So we'll change that to December the 16th. The next action is to buy. So we're buying the put option. Again, that's automatically populated for you. And the strike price we're going to pick, we might use the $61 puts here. And the premium we're going to pay for that is maybe 70 cents. So the next section we're going to put in here, that's your trading commissions. So if you're putting this in or completing this before you've actually placed the trade, you might have to have a guess of what your trading commission is going to be. Now, if you're using interactive brokers, you can roughly gauge about 70 cents a contract. So we're doing 2 contracts, so maybe our trading commissions is 140. The next section here is our net premium after trading commissions on a per share basis. Again, it's automatically calculated out for you. So all this is doing, it's adding in the cost of the trading commissions to what you've paid out to buy the long put and reflecting it back on a per share basis. So you can see it's adding about 1 cent of cost onto the actual purchase of those put options. The next heading is our probability of success. So again, that's our probability of profit. That's going to be automatically given to you from your broker. And for a trade like this, it might be about 48%, for example. And that's important to put in there to know that this has only kind of got a 50-50 chance of winning here. So everything else then and thereafter is automatically calculated out for you. So if we look at our max loss position here, the system is or the spreadsheet is telling you that you can only lose $141.40. So that's just equal to our net premiums multiplied by the number of contracts that we've done. So it's $141.40. And we make that max loss at expiry when the share price finishes above $61. So obviously with a long put strategy, it's a bearish strategy. As the share price is falling, we start to make money. So if the share price actually goes up, we lose money. The max profit is technically unlimited because the long put will continue to gain in value as the share price drops below the break even point and continues to fall. So we can't exactly gauge what our max profit is going to be. So it's technically classified as unlimited. And our break even price is $60.29. So that's simply equal to your strike price minus the cost, the net cost of what you've paid out for the put option. And above that price, we make a loss. Below that price, we start to make a profit. So we've included some important notes here in the trade. And you can see here, we're saying, look at the profit and loss tables below. We're going to show you and go through that with you now in a moment. But we've also said that this trade carries defined risk. So that's important, especially if you're a beginner or a novice trader, because with option strategies, you can have defined risk trades or undefined risk trades. So a defined risk trade is you know exactly what you're going to lose when you place the trade. Undefined risk means you don't know what you're going to lose. Losses can continue to accumulate if the trade goes wrong. So the good news here is that this trade is defined risk. You cannot lose any more than your investment. But please remember, put options are time wasting assets and you need the share price to move before expiry in your favor. Otherwise, the value of that put option can expire to zero. And it's best placed to buy these put options when implied volatility is low. And the reason is that you'll be able to buy them cheaper than when implied volatility is high. Lower risk or novice investors should really switch to the bear put spread instead. It's a lower risk strategy, but it has a defined reward as well. So the downside is your profits won't be as big, but the plus side is your risk is lowered greatly. So let's go through our profit and loss table. And all we're doing here is a what if scenario. So what we're saying here is, what if Microsoft was at $51 at expiry on December the 16th? Or what was it at 58? Or what would it be at 64? What would it mean in terms of profit and loss for us? So the first thing we put in is the net debit we've paid. So we paid out $141.40. So no matter what happens to share price, that's a cost to us. So it's going to be in our profit and loss table. But then we get to the value of our long put at expiry. And you can see here at $51, the put that we own has $2,000 of value. So why is that? Well, remember, we bought the $61 put. If the share price is at $51, that put option is $10 in the money. Now, we bought two put option contracts. So 2 by 10 is 20. And remember, in the options market, one contract controls 100 shares of stock. So 20 by 100 is $2,000. At 52, it's $1,800. At 53, it's $1,600, and so on and so forth, right until we get above 61. And at that point, that put option has no value at expiry because it's out of the money. Now, all of this is calculated for you. You're not going to have to do this, but it's nice for you to know where the calculations come from. And then we get into our final column here. That's simply our profit and loss at expiry. That's just the value of the put and the cost of what we've paid out to actually buy the puts. So you can see here that we're making profits here. As the share price continues to drop, our profits continue to rise. And then you can see below that, highlighted in red, you can see our max loss. And you can see it's totally limited here to 141.40. That's all we can lose with this strategy. So anything highlighted in green is profit, anything highlighted in red is a loss. And then all we've done below that is we've actually graphed the profit and loss table. So you can see here, as the share price is falling, our profits start to go up here. So with the long put strategy, we would really encourage you to go and practice in your simulated trading account. If you're a member of Share Navigator, use your personal simulated account, put on a couple of long puts to practice, and continue to complete these spreadsheets. If you're not a member, please visit our website and join. We will give you a personal simulated account. You can practice all of your option trades risk-free, and even better, at the end of every month, you can make a profit as we give out cash prizes to the top 3 traders of our membership every single month.